Imagine waking up to news alerts that overnight tensions between major powers have escalated sharply. Markets open down. Commentators use words like unprecedented and historic. Your retirement account, built patiently over years of disciplined contributions, suddenly shows a loss equivalent to several months of your salary. You refresh the screen. The numbers are still red. Your mind begins racing. Should you sell and wait this out? Should you move to cash? What if this is the beginning of something far worse? You think about your family, your future, the decades of work ahead. You do not want to gamble with everything you have built. In moments like this, the temptation to act feels overwhelming. Doing nothing feels reckless. Yet what you do in the next few days could quietly determine the trajectory of your wealth for the next few decades. Here is the uncomfortable truth. The greatest danger to your portfolio during a geopolitical crisis is not the volatility on the screen. It is the story you begin telling yourself about what that volatility means. When global conflict risk rises, the human brain does what it evolved to do. It scans for threats. It magnifies worst-case scenarios. It assumes that what feels catastrophic in the present will remain catastrophic indefinitely. That instinct kept our ancestors alive. In financial markets, it quietly destroys wealth, because markets are not simply reflections of headlines. They are reflections of the collective expectations of millions of participants. The moment tensions escalate, prices adjust. They fall not because the world has ended, but because uncertainty has increased. And once uncertainty is priced in, the next move depends not on fear itself, but on whether reality turns out better or worse than what investors already anticipate. This is where the disciplined investor separates from the reactive one. John Bogle built his philosophy on a simple observation. No one can consistently predict the future. Not professional money managers, not television commentators, not economists with elegant models. The future arrives in surprises. Wars begin unexpectedly. They also end unexpectedly. Markets panic. Markets recover. The only reliable edge available to ordinary investors is participation in the long-term growth of businesses across the entire economy. When you own a broad index fund, you do not own a prediction about next quarter's earnings. You own factories, software companies, logistics networks, pharmaceutical labs, consumer brands, energy producers, and thousands of other enterprises adapting in real time to changing conditions. Some will suffer during conflict. Others will adapt. A few may even become more essential. The index quietly reshuffles itself over time, adding new winners and removing failing firms without you having to guess which is which. Now consider what happens when fear pushes you to sell. You convert ownership of productive businesses into cash at a moment when prices reflect maximum uncertainty. You lock in losses that were previously only temporary fluctuations. Then you face a second decision that is even more difficult. When do you get back in? Because markets rarely send engraved invitations announcing that it is safe to return. Recoveries often begin while headlines are still grim. The largest daily gains in market history have frequently occurred within days or weeks of the largest declines. Miss just a handful of those recovery days and the long-term compounding of your portfolio changes dramatically. This is not theory, it is arithmetic. Imagine two investors with identical portfolios worth $300,000 before a crisis. The market declines by 30% amid escalating global tensions. Both accounts fall to $210,000. The first investor, overwhelmed by fear, sells and moves entirely to cash. The second continues holding and keeps contributing each month. Over the next decade, suppose the market returns an average of 8% annually from that lower starting point. The disciplined investor's $210,000 compounds back above its previous peak and continues growing. The fearful investor sitting in cash waits for reassurance. Perhaps they re-enter after markets have already recovered halfway. They buy back at higher prices, having crystallized the loss and forfeited part of the rebound. The difference between these two paths is not intelligence. It is temperament. And temperament, unlike prediction, is within your control. The idea that world war risk invalidates long-term investing rests on a hidden assumption. It assumes that markets cannot function under stress. Yet the history of global markets tells a more nuanced story. Businesses operate through conflict, supply chains reroute, governments respond, innovation accelerates under pressure. Economic growth does not move in a straight line, but over long stretches of time it has trended upward, powered by human ingenuity and the basic drive to improve living standards. None of this means volatility will be gentle. It means volatility is the price of admission. When you invest in broad markets, you are not buying stability. You are buying exposure to the long-term productivity of millions of people waking up each morning trying to solve problems, serve customers, and earn profits. That productivity does not vanish because headlines darken. It adjusts. It adapts. It endures. The real question is whether you can endure with it. Because the Bogle investor's playbook was never about finding calm seas, it was about building a vessel sturdy enough to cross rough water. Low costs ensure that more of the market's return accrues to you rather than intermediaries. Broad diversification ensures that no single company or sector can sink your entire ship. Long-term discipline ensures that temporary storms do not dictate permanent decisions. When fear whispers that this time is different, it is inviting you to abandon a system designed precisely for uncertain times. And yet, there's a deeper layer to confront. What if the fear feels justified? What if rising global tensions truly signal a structural break in the world economy? What if the future is not simply volatile, but fundamentally diminished? These are not foolish questions. They are serious concerns. And to navigate them wisely, we must look backward before we look forward. To understand how markets behave when the world feels as though it is coming apart, we have to step outside the emotion of the present moment and into the record of the past. Consider the period surrounding the Second World War. In the late 1930s and early 1940s, global conflict was not a theoretical risk. It was a lived reality. Entire economies were mobilized for war. Cities were destroyed. Political systems collapsed. The human cost was staggering. If there were ever a moment when long-term investing might have seemed naive, that was it. Yet even during that period, publicly traded companies continued operating. They shifted production toward wartime needs. Industrial output surged. After the war ended, reconstruction efforts sparked enormous economic expansion. Investors who had owned broad baskets of American businesses through that era experienced volatility, certainly, but they also participated in one of the most powerful multi-decade growth periods in market history. Move forward to the 1970s, a decade marked by oil embargoes, geopolitical tension, inflation, and deep pessimism about the future of capitalism. Markets struggled. Returns were poor in real terms for several years. Many investors concluded that the system itself was broken. Yet those who continued investing through that bleak period, reinvesting dividends and maintaining discipline, positioned themselves for the powerful bull market that began in the early 1980s. Then there was the global financial crisis of 2008. Banks failed, credit markets froze, major institutions collapsed or required rescue. The stock market fell by more than 50% from peak to trough. For many investors, it felt indistinguishable from systemic failure. The language used at the time was apocalyptic, and yet, from the lows of 2009, markets began a recovery that extended for more than a decade. Investors who sold near the bottom locked in catastrophic losses. Investors who held broad index funds and continued contributing during the downturn purchased shares at deeply discounted prices. Over time, those purchases compounded into substantial gains. History does not repeat in identical form, but it rhymes in pattern. Periods of extreme uncertainty are followed by adaptation. Markets fall sharply when fear surges. Then, often quietly and before confidence fully returns, they begin to recover. Here's the critical insight. When you invest in a total market index fund, you are not betting on a single country's uninterrupted dominance. You are buying ownership in a dynamic system that evolves. Companies that cannot adapt shrink or disappear. New companies emerge. Entire industries transform. The index reflects this constant process of creative destruction without requiring you to predict its direction. Now, bring this back to your daily life. You contribute a portion of each paycheck to your retirement account. The money is automatically invested in a low-cost fund that tracks thousands of companies. During calm periods, the balance grows steadily. During crises, it declines. The numbers on the screen fluctuate, sometimes violently. If you are 35 years old, with 3 decades before retirement, a market decline is not simply a loss. It is a repricing of future expected returns. When valuations fall, the prospective long-term return from that lower starting point increases, assuming the underlying businesses remain productive. In plain language, downturns make future growth cheaper to buy. But the human mind does not experience it that way. It experiences loss viscerally. Behavioral economists call this loss aversion. The pain of losing $1 feels roughly twice as intense as the pleasure of gaining $1. When your portfolio drops by $50,000, you do not calmly calculate future expected returns. You feel regret. You feel self-doubt. You feel an urgent need to stop the bleeding. Recency bias compounds the problem. We naturally assume that what has happened recently will continue. If markets have fallen for several weeks amid escalating global tensions, it feels rational to expect further declines. The possibility of recovery feels remote, even though historically recoveries often begin when pessimism is most widespread. Her behavior adds another layer. When colleagues at work mention moving to cash, when financial news features anxious interviews, when social media amplifies worst-case scenarios, standing still feels lonely. Selling feels like joining a protective crowd. What if the greatest risk to your portfolio during war is not war at all, but the perfectly human impulse to seek emotional relief? Because selling provides immediate relief. The red numbers stop fluctuating. The uncertainty feels contained. You have acted. You have done something. But relief is not the same as wisdom. A broadly diversified, low-cost index portfolio is built on the premise that no individual can consistently outguess the collective judgment of millions of market participants. Prices already reflect known risks, including geopolitical ones. By selling in response to fear, you are implicitly claiming insight superior to that collective assessment. John Bogle often reminded investors that the stock market is a device for transferring money from the impatient to the patient. That transfer does not require villainy or deception. It requires only emotion. The patient investor accepts that global conflict risk is part of the landscape of human history. They do not minimize its seriousness. They simply recognize that abandoning ownership of productive assets during crisis has historically been a costly response. Still, a lingering objection remains, and it deserves to be confronted honestly. What if the future conflict is so severe that markets do not recover in the way they have before? What if this time the damage is permanent? That question sits quietly beneath every historical comparison. It is easy to point to past recoveries and feel reassured. It is harder to confront the possibility that the next crisis could break the pattern. What if this time is different? It is a serious objection, and dismissing it with cliches would be intellectually dishonest. There have been markets in history that did not recover for generations. There have been countries whose political and economic systems were permanently altered by war. To pretend that global equities are indestructible would be naive. But here is the deeper layer of analysis that most panic overlooks. When you invest in a broad index fund that spans thousands of companies, often across multiple countries, you are not making a bet on a single government or a single outcome. You are making a bet on the continued existence of organized economic activity. You are betting that human beings will continue to produce goods, deliver services, solve problems, and seek profit within some functional system of exchange. If a global conflict were so devastating that diversified ownership of productive businesses failed permanently, the implications would extend far beyond your brokerage account. In such a world, the value of cash, bonds, or even gold would be uncertain. Financial assets of all kinds rely on some degree of social and economic continuity. In other words, abandoning equities for perceived safety does not eliminate existential risk. It merely reshuffles it. The more practical question is not whether markets could ever fail. It is whether shifting in and out based on fear improves your odds. Historically, it has not. Imagine two colleagues, Daniel and Maria. Both are in their early 40s. Both have spent nearly 2 decades contributing steadily to low-cost index funds. When geopolitical tensions rise and markets fall sharply, Daniel cannot sleep. He reads analysis late into the night. He calculates worst-case scenarios. Eventually, he sells most of his portfolio, convinced that preserving capital is the only rational choice. Maria feels the same fear. She is not immune to it. She watches her balance decline and feels the sting. But she returns to first principles. She reminds herself that she owns slices of thousands of companies. She remembers that her investment horizon stretches 20 years or more. She continues contributing even though it feels uncomfortable. Over the next several years, markets fluctuate wildly. There are further declines, but there are also sudden recoveries. Daniel waits for clarity. He tells himself he will reinvest once the outlook stabilizes. But clarity never arrives in a clean announcement. By the time economic data begins to look reassuring, prices have already risen substantially. He buys back at levels far above where he sold. Maria's account, meanwhile, has quietly accumulated additional shares during the downturn. The dividends she reinvested purchased more ownership at lower prices. When markets eventually regain momentum, her portfolio benefits not only from recovery, but from the larger base of shares she acquired during fear. A decade later, the difference between their accounts is not trivial. It is the compounded result of a handful of emotionally driven decisions. This is where the emotional core of disciplined investing lies. It is not in spreadsheets or return charts. It is in the quiet moments when no one is watching and you choose patience over panic. There's also a structural reality that strengthens the case for broad diversification during uncertain times. Modern global index funds do not remain static. Companies that decline in relevance shrink within the index. Companies that innovate and grow occupy larger weights. If one region suffers prolonged stagnation, global diversification means your portfolio is not entirely dependent on its recovery. This adaptability is often invisible. It happens behind the scenes. Investors sometimes imagine an index fund as a frozen basket of companies. In reality, it is a living reflection of market capitalization, constantly adjusting as capital flows toward more productive enterprises. The strongest argument against staying invested during rising war risk is emotional, not mathematical. It feels irresponsible to ignore danger. It feels passive when action seems necessary. Yet action is not inherently virtuous. In investing, unnecessary action is often the costliest mistake. The discipline to hold through crisis does not mean blind optimism. It means acknowledging that markets price in fear rapidly, that recoveries are unpredictable, and that your advantage as an individual investor is time. Professional traders operate on short horizons. Institutions face quarterly performance pressures. You, investing for retirement decades away, possess flexibility they do not. The paradox is that long-term investing requires short-term emotional resilience. You must withstand discomfort today to capture growth tomorrow, and here's the transformation available to those who internalize this. Instead of viewing volatility during geopolitical tension as a signal to retreat, you begin to see it as a test of your framework. If your allocation was appropriate before the crisis, aligned with your risk tolerance and time horizon, then the crisis has not invalidated it. It has revealed whether you truly understood it. The Bogle Investor's Playbook does not promise calm markets. It promises a rational response to turbulent ones. It asks you to define your strategy in moments of clarity so that you are not forced to invent one in moments of fear. Still, philosophy alone is not enough. At some point, this must translate into the daily behaviors that shape your financial life. When philosophy meets real life, it expresses itself in small, repeated decisions rather than dramatic gestures. You wake up, go to work, earn a paycheck, and a portion of that paycheck flows automatically into your retirement account. That quiet automation is more powerful than any prediction about geopolitics. It converts human labor into fractional ownership of global enterprise, month after month, year after year. During calm periods, this process feels almost boring. Contributors go in, markets drift upward over time. Statements arrive with modest gains. You begin to assume that progress is normal. Then volatility returns. Headlines darken. Your balance shrinks. The same automatic contribution now buys more shares than it did a few months earlier, but emotionally it feels like throwing money into uncertainty. Here's the reframe most investors never fully absorb. When markets decline, your future expected returns increase, all else equal. Lower prices imply higher prospective yields on earnings and dividends. The very event that feels threatening to your current balance can enhance the growth potential of new money invested. This is not optimism. It is arithmetic. Consider a simplified example. Suppose a broad index of companies is priced so that its long-term expected return is around 6% annually. If fear drives prices down significantly while underlying productive capacity remains intact, the expected return from that lower price point may rise to 7 or 8%. Your ongoing contributions during that period are effectively purchasing future cash flows at a discount. Over decades, small differences in annual return compound dramatically. A portfolio growing at 6% for 30 years roughly multiplies several times over. Increase that average to 8% because you invested more heavily during discounted periods, and the final value can be hundreds of thousands of dollars higher, even if the difference in annual percentage seems modest. The challenge is that the opportunity arrives wrapped in anxiety. This is why simplicity matters so deeply. A low-cost total market index fund does not require you to decide which industry will benefit from conflict or which country will suffer most. It requires only that you continue participating in the aggregate productivity of thousands of businesses. By keeping costs minimal, you ensure that the largest possible share of whatever return the market delivers accrues to you. Costs are one of the few variables that you can control completely. If a fund charges 1% annually instead of 1/10 of 1%, that difference compounds just as returns do, but in reverse. Over 30 years, seemingly small fee differences can consume a significant portion of your final wealth. During volatile periods, high fees become even more painful because they are deducted regardless of performance. There is a quiet discipline in focusing on controllable factors when the uncontrollable dominates the news cycle. You cannot dictate geopolitical outcomes. You can control your savings rate, your diversification, your costs, and your behavior. At this point, some viewers may feel a subtle shift. The narrative of danger begins to coexist with a sense of structure. If you find value in thinking about investing this way, grounded in evidence rather than headlines, consider continuing to learn within this framework. The more deeply you internalize it, the less fragile your confidence becomes when volatility returns. Now, here is an observation that often surprises people. Rising global conflict risk does not weaken the case for broad diversification. It strengthens it. When uncertainty concentrates in specific regions or sectors, concentrated portfolios become vulnerable. An investor heavily exposed to a single country or industry may experience severe drawdowns if that area suffers disproportionately. A total market approach spreads risk across geographies and economic activities. While no portfolio is immune to global downturns, diversification reduces dependence on any single narrative unfolding favorably. In this sense, an index fund is not a bet that everything will go right. It is an acknowledgement that some things will go wrong, and you do not know which ones in advance. Long-term wealth building is less about forecasting and more about humility. It recognizes the limits of individual foresight and compensates with breadth and patience. The investor who endures geopolitical storms with discipline does not do so because they are fearless. They do so because they have pre-committed to a process. They have chosen an asset allocation aligned with their capacity for risk. They rebalance periodically, trimming what has grown disproportionately and adding to what has lagged, not because headlines demand it, but because their plan does. Over time, this steady behavior creates something more valuable than high short-term returns. It creates trust in your own judgment. You begin to see volatility not as a personal threat, but as a recurring feature of ownership. That shift in identity, from anxious speculator to patient owner, is the quiet reward of disciplined investing. And when the next wave of alarming news arrives, as it inevitably will in some form, you will recognize the pattern. Fear will surge, prices will move, commentators will speculate, and you will face the same fundamental choice between reaction and resolve. What remains is to understand what that choice ultimately represents for your future. Return to that morning when you refreshed your account and saw red across the screen. The fear felt immediate. The future felt fragile. It seemed as though global events far beyond your control were reaching directly into your household finances. Now step back and see that moment in a wider frame. Across history, there have always been mornings like that. Investors in the early 1940s faced headlines that threatened the stability of entire continents. Investors in the 1970s confronted energy shocks and deep economic malaise. Investors in 2008 watched financial institutions crumble. Each era felt uniquely dangerous to those living through it. Each era produced confident voices insisting that the old rules no longer applied. And yet, across those decades, the underlying engine of markets persisted. Businesses continued striving to earn profits. Workers continued earning wages. Entrepreneurs continued earning wages. Spark and production of innovating. The composition of the market changed. The dominant companies of one generation gave way to new leaders in the next, but the aggregate enterprise of human productivity endured. When you invest through a broad, low-cost index fund, you align yourself with that enduring process, rather than with any single forecast about how the next crisis will unfold. This does not make you immune to loss. It does not guarantee smooth returns. It does something more subtle and more powerful. It positions you on the side of participation rather than prediction. Prediction tempts you to believe that if you are clever enough, attentive enough, or fast enough, you can sidestep danger and capture upside. Participation accepts that you cannot foresee the sequence of shocks, rallies, recessions, and recoveries that will occur over the next 30 years. Instead of attempting to dodge each storm, you build a vessel designed to survive many of them. The Bogle Investor Playbook is simple by design. Own the market, keep costs low, stay the course, rebalance occasionally, continue contributing. Let compounding do the heavy lifting over decades. Compounding is often described in abstract mathematical terms, but its emotional dimension is rarely discussed. It requires you to endure long stretches where progress feels slow and intermittent. It asks you to trust that small, consistent returns reinvested year after year can accumulate into significant wealth. If you begin with $200,000 and earn an average of 7% annually over 25 years, reinvesting all dividends, that portfolio grows to well over $1 million. The transformation does not occur because of a single brilliant trade. It emerges from the quiet multiplication of returns on returns. Interrupt that process repeatedly by selling during fear and re-entering during optimism, and the end result can be dramatically smaller. The rising risk of global conflict tests whether you truly believe in that arithmetic. It is tempting to think that caution requires retreat, but in investing, caution often means adherence to principle. If your asset allocation was chosen thoughtfully, calibrated to your risk tolerance and time horizon, then abandoning it in response to frightening headlines may increase rather than reduce long-term risk. The deeper comfort comes from recognizing what you actually own. You do not own ticker symbols. You own claims on real companies that produce food, develop medicine, build infrastructure, create software, transport goods, and provide countless other services. Even in times of conflict, many of these activities remain essential. Human societies adapt because they must. Of course, none of this diminishes the human cost of war or instability. Investing discipline is not indifference to suffering. It is simply a recognition that your financial plan must be robust enough to function in a world that is sometimes turbulent. At some point, every long-term investor confronts a defining moment. It may not look dramatic from the outside. It may be nothing more than a decision to leave a contribution unchanged when markets are falling, but internally, it represents a commitment. You choose to align your behavior with evidence rather than emotion. Years later, when you look back, that quiet choice may matter more than any market forecast you ever considered. The world will continue to produce uncertainty. There will be future crises that feel unprecedented. The language will always be urgent. The charts will sometimes be alarming. But the core dynamic of markets, the exchange of capital for productive effort, has shown a remarkable capacity to endure. The ultimate insight is this: your advantage as an individual investor is not access to superior information. It is the ability to be patient. Institutions must answer to clients quarterly. Traders must respond to daily price movements. You, investing for retirement decades away, can allow time to smooth volatility and let compounding operate. When World War risk rises, the Bogle investor does not claim to know what will happen next month. They simply reaffirm what they own and why they own it. They accept that volatility is the toll paid for long-term growth. They refuse to let fear dictate permanent decisions. On that frightening morning, the numbers on the screen were not a verdict on your future. They were a reminder that ownership comes with fluctuation. The real determinant of your financial trajectory was never the headline. It was the steadiness of your response. In the end, wealth built through disciplined index investing is less about brilliance and more about endurance. And endurance, quietly practiced over decades, has a way of outlasting even the darkest headlines.